how it will begin by introductions. If I may ask Sheikh Hamad to make an introduction, and then Bassam and Akbar, and then we can start the conversation.
Assalamu alaikum. Good afternoon. I'm Hamad Al-Thani. I'm a Senior Vice President of Investments and Treasury at QIC, and I also run Epicure Investment Management, which is a fully owned subsidiary of QIC that specializes in asset management across different asset classes. So, Bassam?
Thank you, Sheikh Hamad. I am Bassam Slim. I'm a portfolio manager at Aventicum Capital Management Qatar. We focus on MENA and frontier markets, and I run one of the largest MENA funds in the region.
Thanks, Bassam. This is Akbar Khan at Al-Rain Investment. I'm the Senior Director there. We invest in Qatar and the region in both equities and in fixed income. Obviously, everything we do is Sharia compliant. Looking forward to the conversation.
Yeah, so I'll just make a quick introduction of myself as well. Mohsin Mujtaba. I've been with the stock exchange for about 16 years now. I head the product and market development, and all these esteemed panelists that you see are friends and customers. I like to believe that they are more friends, and we have been together working for the past decade to shape the industry, and have been instrumental in doing a lot of new initiatives, which we will discuss during the course of the conversation. So let's, before we move ahead, just wanted to share a fun fact with all of you. We are connected on Zoom right now, and interestingly, this just came out yesterday, that Zoom is now bigger than 7 largest airlines, quoted listed airlines in the world, which shows the kind of times we are in, and what it is doing to the norm that we were used to. And let's hope this is going to change the course of the way things are done, because clearly, I think the way things were being done there was definitely some issue there. That's why a lot of global economy is broken now. So with that, I think let's move to our discussion. The topic, as you all know, is COVID-19, oil prices, and the outlook on the Qatari stocks. So let's tackle each one by one. The first one is obviously COVID-19. As we say that we need to, what's your view? What's happening with COVID-19 locally, globally?
Well, I think from a health perspective, alhamdulillah, locally, you've seen very low mortality rates. You've seen a relatively low level of intensive care. The hospitals are coping, so alhamdulillah. If you look at the economy overall, the industries that are impacted are mainly on the consumer face side, where the government has taken measures to prevent restaurants, etc. But on the construction side, some areas of manufacturing, you've seen a bit of a halt when the industrial area was closed, and that's starting to pick back up. So I think in terms of lost productivity, we're better off than a lot of other countries. If you take the macro perspective with COVID-19, the simplest way to explain it, I see we have some investors that haven't invested in stocks here before. I'm not sure if they're familiar with the international stock markets. So just to give them a very brief overview as to what the real problem is, you have a lot of companies that have ongoing expenses, whether or not they make sales or not. So if you imagine something you're familiar with, like a department store, these guys pay rent, they have staff, they have inventory, and when their business stops, they're not able to make the same level of sales. In some cases, they're not able to make any sales at all. They still have expenses to pay in terms of rent, in terms of staffing, and some of them have a lot of debt which needs to be serviced. So different countries have managed this differently. So in the US, small and medium enterprises got a lot of loans from the government, these forgivable loans. Listed companies were asked to refund the loans. So you're in a position where these companies, some might have to move into bankruptcy, others might survive, but as weaker versions of themselves. And like you mentioned with Zoom, you're going to find some companies, their market share is going to grow because they're either providing a service that wasn't essential before, that is now, or a company like Amazon, where it's just a push towards the digital. So be very careful when you're investing as to, is the sector you're investing in going to be impacted in the long term? So I'd avoid this kind of short-term actually can't service. They have a lot of fixed expenses that they can't scale down easily. Or is it certain types of business disruption, things in their leases, flexibility with staff, different types of insurance? The global insurance industry is also one of the industries that could be hit with business interruption insurance globally. Is this a government issue, or is this an insurance issue? Should it be covered or not? So it's very, very complicated, but any investor that's looking to invest regionally or globally, if you're not able or willing to put in the time to study the individual stocks, to look at the micro and macroeconomic perspectives, the best way to play the markets is through ETF. So you have two ETFs here, that one Islamic, one conventional, that cover the companies in those two indices. And even if you wanted to invest in the Dow Jones, you have various ETFs beneath that cover sectors, so you can make sector calls. So that's the easiest way for someone to make equity investments if they're not willing to trade markets day to day. Our companies have generally been more resilient, but we've suffered over the past few years due to lower oil prices, which is going to be our next topic. So I won't go into that now. I'll pass on to the next speaker.
Sure. Bassam, what do you think is going on with COVID situation domestically?
Sure. I mean, it's interesting that Qatar took a slightly less strict approach, in the sense that we've seen, strict lockdowns across various countries around the world, and certainly in the region, and social distancing. Clearly, the mortality numbers, as Sheikh Hamad mentioned, are encouraging, and although it's a bit worrying that the numbers are still ticking up at a fast clip. So hopefully we see a lot more people conform to social distancing measures. This is obviously quite serious, because it once we get control of the outbreak, we'll hopefully get back to business. Businesses can start functioning at lower capacity, sure, but at least we'll start to see some openings, because the toll it has, businesses shutting down, has a significant toll on our economies, and clearly we want to minimize that. The Qatari government already announced a couple of stimulus measures. Monetary fiscal policy response from the Qatari government should help slightly cushion the impact. However, we'd like to see a little bit more of that, especially when it comes to losing labor force, and because it took us years to get to where we are today, and we'd like to see that continue, because it affects the aggregate demand in the country, and this is something very important for the private sector. We already know that the Qatari economy is by and large driven by public sector institutions and government related institutions, and very much quarrying and mining and the petchem industry. However, we'd like to see more of the private sector pick up the slack, and for that to happen, we need companies that are sustainable, healthy, and it's key for these companies to get support to be able to survive the current storm that we're in. And I agree with Sheikh Hamad that relatively speaking, we're seeing some sort of resilience so far, but we're a bit careful because we don't think we've seen yet the Q2 numbers should give us a better picture. Maybe Akbar has more to say.
Yes, Akbar.
So there are some.
How are you guys doing at investment about the COVID situation?
Sure. There's some comments in the chat that my sound isn't great. Can you hear me clearly?
It's better, Akbar. You can keep going.
Okay. So I think one of the things what's been discussed already is about the economy, but I think one of the things, if we just step back and have a look at where things stand for Qatar, but in the last 5 years, this is the country's third crisis. In 2014-15, we had oil collapse. We went from $120 down to the famous $30. It started at the end of 2014. The pain was evident in 15-16, obviously, and then the oil prices started rising. So that was one crisis that the country was faced with and had to deal with. We then in 2017 had the blockade, which was obviously another crisis of an entirely different kind and far worse than the previous one. And we kind of got through that extremely well. And now we are faced in 2020 with the third one. So I think as a country and as people living in the country, we aren't strangers to things going wrong. And the reason I mention that is because it's interesting looking at how responses have been and populations have responded to the COVID-19 problem across the world, is that for a lot of people, they've not had a crisis in their country, luckily for them, for years or decades. And this has come as the psychological shock and the social shock is obviously very extreme. But also at a more practical level and relating to investments, as a result of the blockade, the country had to in literally overnight entirely revamp and change its supply chain and move to multi-sourcing, move to seek greater variety of products, greater variety of relationships with countries who could supply and basically open Qatar's eyes to the world to see what else is out there. All of Qatar, like the rest of the region, had been very reliant on its supplies from within the region. This has been a huge benefit to us because in the last few weeks and months, when we go to the supermarket, we see the same things that we've always seen. And we see the same products that we've seen. If you go to the supermarkets in other countries in the region, they're going through the same thing that we did 3 years ago. So a lack of availability of certain products. Suddenly there are products that we've never seen those brands before because the retailer or the government is seeking any brand possible from anywhere to put on their shelf to kind of supply the product. We went through this a few years ago and we've now come out the other side. So I think that was a big positive and that was a big source of calm and relative ease that we've had within Qatar this time around. The other, so the supply chain and sourcing has not been an issue. The other aspect, I think, and if we want to relate this more to the markets, and Sheikh Ahmad mentioned this earlier as well, or referred to it, is there are companies in probably three different types of categories. The companies which are really struggling and have business models and businesses that have sort of pretty much fallen apart. because of the lockdown and because of what the restrictions that exist. So, you know, in terms of listed companies, we're talking about some of the smaller ones like Salam, like Qatar Cinema, Ezdan has malls, etc. They've been hit very, very hard. You have others which have sort of been hit in some parts, but are still continuing in other parts. Banks are a good example of that, and that's obviously important given how much they are of the market. Banks are sort of operational, but also sort of not operational. You know, there will be lower fee income, there will be lower loan growth, but they are hopefully for them still getting income coming in. They're still paying depositors. People are still using their credit cards. Yes, there'll be low activity in terms of trade and LCs, etc. So there is some disruption, but they are still functioning. The other big sector for our market, obviously, is petrochemicals. Operationally, they're functioning fine. Unfortunately, the product that they are selling has collapsed in price, so profits have collapsed. But operationally, so the COVID issue is financial rather than or price rated, not volume rated. Those are the two most important sectors. But I mean, there are others which are utilities, which are open as such. You know, we're still using electricity and water and paying our bills. You have industrials which are hit pretty hard because of some of the restrictions, because of the lack of demand, because of a number of issues with the economy. Telcos are, again, a bit like banks, sort of operating, but not operating at full strength. Not a lot of handsets are being bought at the moment. Not a lot of roaming is happening. You know, there is a lack of growth of new subscribers. So, but ultimately, those of us who have postpaid connections are still paying our bills, and we're using our phone calls, and that's how we're connecting, and we're all looking at each other today. So, I think it's that's the kind of gray area category where they're sort of working and sort of not. And then there's the category which is booming, and that is to do with the non-discretionary consumer, or in Qatar that comes down to basically people related to making food or selling food. So I'm talking about Almira, I'm talking about Baladna, I'm talking about Zad, I'm talking about Widam. These are the sort of companies that are thriving. And I'm obviously only listing the companies.
We'll come back to.
And so that
we'll come back to the specifics.
Okay. So I think that would be from
we'll come back to the specifics.
Sure. So that would be these are the companies that have directly been affected one way or another from COVID to different degrees, or are benefiting. I'm still having people saying they're struggling to hear me. So are you guys struggling to hear me?
Well, Akbar, you answered part of all three questions. So whatever they heard, I'm sure was meaningful.
We can all go home now.
So I think let's go back. Let's take a step back and see where we are with the COVID. And I'll try to summarize. So we established our view on the COVID situation. So as Akbar was saying, that I think this is probably the third crisis that the Qatari economy has seen in the last 5-6 years. To 2014, global oil crash. Then 2017, a situation is specific to Qatar, but that allowed Qatar to be more resilient and diversified in its supply chain, which is helping today to cope with the crisis where the rest of the world is actually dealing with their supply chain issues. So in a way, I think we had two practice matches, this third one. So from a supply chain perspective, I think we are doing fine. However, I think it's important, as Bassam mentioned, that we need to maintain social distancing. We need to make sure that people are staying home to make sure that the healthcare system doesn't get overburdened, and we can soon get back to schools, to malls, to offices, to kickstart the economy and the retail segment per se. And I think Sheikh Hamad, you were mentioning that obviously there is an impact. However, there are new business models that need to be shaped and discovered to use of this, one of the generations that has actually seen negative oil prices. I don't know if anybody else will see this again in the next 25 years or 30 years. However, while we are discussing, I think the next expiry of the WTI futures contract is 21st or 22nd of May. So let's see what happens as towards the run-up of that expiry. But hopefully we will not see negative prices again. But analytically.
Well, I know a lot of us on commodities understand why the price of the WTI went negative. Some of the viewers might not, so I'll just cover that briefly, and then I'll give you my view on LNG oil and its impact on the domestic economy in a second. So what happened with the negative oil prices in the States was that there's a specific contract traded, Texas Intermediate, WTI, that's traded in the States. Now, part of the contract requirements is delivery in a city in Oklahoma where they have a lot of their storage. Now, what happened was that within that city, the storage was reaching capacity, and a lot of traders who were speculating on the price of oil, who were not end users of the oil contract, did not want to take physical delivery. Now, just to put this into context, if you want to take physical delivery of a few 100,000 barrels of oil in Oklahoma, even if you have a buyer, you would have to lease tankers, fill them up, move them over to wherever your buyer is. So there's a cost associated with that. So there was panic selling on behalf of those buyers because they did not want to take physical delivery. They had nothing they were able to do with the oil, push negative tariff, where someone else comes in and says, I will take the burden of the transportation, but that cost is going to be minus 30 something dollars at the trough. So I think that even going forward, seeing net oil price, I think potentially a rewrite of the WTI contract to be closer to Brent, where you can have delivery in multiple locations, you will have larger storage capacity. I think that it might happen again during the Corona era, but I think that it's a structural problem that is easily solved. In the long run, the US shale industry, a lot of the higher cost offshore oil and gas projects that had a high benchmark price that oil and gas companies were set on investing in developing, the banks were funding, you're going to have a lot more caution approaching those projects. So in the mid to long term, I think oil prices are definitely going to stabilize, and by the time, but I think a range of maybe between 50 and 70. And then the current stress in the oil market, I think it's probably a 6 to 12 month game. You already started seeing manufacturing start to pick up, unless we have another really bad hit from Corona where manufacturing, traveling gets hit again. You're not going to see this level of surplus. But having said that, you're not going to have people driving as much, flying as much in the meantime. So it's not going to be, the glut is not going to be cleared up very quickly, but the extreme stress is going to be gone in 6 to 12 months. From a domestic perspective, in 2015, the oil prices crashed. GCC economies, they took a very stern move towards austerity, towards cutting the budget and balancing the budget. And at that time, the economies were purely based on oil and gas spending. So government had to take a stern call. Now, 2 years after that stabilization, you had some additional jobs, some additional growth in the economy. It was very slow. And I think that governments have learned that it's not easy to replace these white-collar jobs. There's a value to having them in the economy. There's a multiplier effect. And from an economic perspective, while the first round of austerity was very good in the sense that you had a lot of bloated organizations, now you're already slimmed down. From that slimmed down point, you might economically think that being counter-cyclical is better than being cyclical. So instead of cutting the budget more severely when the oil prices crash and raising taxes as we've seen some of our neighbors do, which, you know, I'm not here to criticize anyone's policy. I think that a more rational approach would be potentially capital projects that are quite expensive and that don't make sense in the context of very low oil prices, but doing what you can to maintain the number of white-collar employees, to maintain the efforts to grow the private sector, to help the real estate sector recover, because in the long run, when you're back in a bull economy, you should start doing the opposite and building a counter-cyclical buffer and saying that now that we're in a boom, perhaps now's the time to add a value-added tax, to add a small income tax, and that will help me in the downturn to cover that shortfall. So, you know, very severe budget cuts, I think, would hurt more than they help. Some winding down and potentially winding up for a company like Qatar Airways, where they said, you know, we have to lay off some employees, but we want to hire them back as soon as the flights start to take off. I think that might not have a significant impact, but we should focus on growing the white-collar labor force, on continuing with the economic diversification efforts, and at the same time, yes, I agree, you need to spend excessive and be able to, you know, modulate that. But you're not going to be able to diversify from a pure oil and gas-based economy by strangling the private sector of government spending. And I think it's a lesson that is being learned in the region and you know, by a lot of countries that are trying to modernize and to change their economic makeup, move towards services, move towards potentially tourism. One real opportunity I see is in terms of supply chain. Historically, globalization based everything on just importing what you can for the cheapest cost. I think now more and more you're going to start looking at certain areas of manufacturing and domestic production, similar to what happened at the beginning of the blockade, where we're like, do we need some level of domestic manufacturing? Let's do more and more of that. And, you know, I was very humbly to make a suggestion. I would look at the healthcare market, for example. You know, I know there's a local factory that makes things like hand sanitizer, and there's, I think Barzan was doing ventilators. But one area where you could potentially grow the private sector is by looking at the medical industry here, which is growing. And by telling it of a certain percentage of your products to be domestically produced by, let's say, 2025. So have targets where in 2 years you want 15 or 20% domestic production, and within 5 years you want 30%. You can highlight the strategic items. In terms of supermarkets, you can have more incentives to them allocating shelf space to local companies. And I think we should have a green field where it's really not for the large corporates or semi-governmental institutions to pick up the slack. I think the small and medium enterprises partnered with the government capital provided from QDB should really move to pick up the slack, grow the private sector, and provide these essential goods and services that we're now realizing we can't always rely on foreign markets to provide. Thank you.
Okay. Well, I think I was looking at the Q&A that is coming in. We have about 11 questions. Half of them are actually about gas prices, are at the right stage during the. I'll read out a few questions, and then the next two panelists have an idea of where the interest is. Will lower oil prices affect the currency peg of Qatari riyals and US dollars? Oil and gas prices, can you please let us know? If the COVID situation remains till August, what is the impact on Qatar and Gulf economy? Yeah, I think people want to understand a little bit more on the LNG prices as well. and the link with the oil prices. So if you guys can focus on that as well during your response on oil.
Sure.
Thank you.
Maybe I'll take a crack at it, and maybe Akbar can also. So let me just take a little step back and really recap how we got to here. So the oil market before COVID-19 impact has already was under stress because of oversupply, and as we all know, historically, OPEC has always tried to balance the market and have been losing market share to the likes of the shale industry in the US. And going into this year, we've already seen, I think, from 2019 baseline, we've seen 2.2 million barrels of oil cuts from OPEC or OPEC plus, as they call it, which includes Russia. Now, once the COVID-19 impact hit global demand, and we started to see some of that impact that trickle in, OPEC plus convened and tried to come to an understanding of further cuts, and obviously those stocks broke down, and we saw a market share war emerge, and we saw around 4 million or 5 million barrels of extra oil come in the month of April. As global economies shut down to fight the outbreak, we saw that in April, I think at the peak, around 35 million barrels of oil demand have disappeared from the market. This is in the context of a severely oversupplied market as well, has created this extreme imbalance and led to a significant increase in inventory across storage facilities globally. At the time, I think the estimated global storage capacity between onshore and offshore was being estimated between 1.1 to 1.5 billion barrels of oil. And at the rate that we were building inventory, it was expected that tank tops will reach full capacity by the end of April. Clearly, as a result, OPEC plus, which is now being called, they came together and announced a massive deal, I think historic, in perspective, of around 19 billion barrels of oil of supply cuts. The numbers are convoluted. It's not 19 million barrels. 3.3 million of those were going into strategic oil reserves, and the baseline was October, when we've already seen some of that cut in year to date. So regardless, without going into too much details, even if you do the math and you run the numbers, with full compliance and assuming that the economy is, we were still looking at tank tops end of May. Now things are getting a little bit better. Compliance with the cuts is looking promising. We've seen shale producers reduce over 1 million barrels already by way of shut-ins. We've seen high-cost projects in Brazil, Norway, etc. reduce supply. So it's, and OPEC is adhering to its OPEC cuts and actually going further out. And we've seen Russia already reducing some of the output. So clearly things are getting better. And if you look at the time spreads, it clearly shows that the contango is no longer as steep as it used to be. Although it's still in contango, which tells the market is still worried about the inventory build, and we'll see how things pan out. But it is clear that short-term oil prices will still be under pressure. Now, longer term, what would determine where oil prices settle at is, one, shape of the recovery in terms of demand, and how compliant the supply cuts remain. We've seen in the past that compliance hasn't been great with oil production cuts. And secondly, we've also seen opportunistic increases. So whenever we saw oil prices rise a bit, some of the producers come back in, and like in the US, for example. Some of those fields cannot or can come back online as quickly because there could be some geological damage to the fields. However, that is a risk worth keeping in. for longer term what the shape of oil prices will be. Secondly, how it affects LNG. Well, one, there's a COVID impact, which is something that we've already seen. We've seen countries send back their quantities, and some of that found itself into the spot market, and the netbacks in the spot market are a lot lower than what they are in under long-term contracts. And secondly, I think the month of April saw probably one of the lowest dispatches of oil LNG vessels from Qatar, and we know that there's a fair bit of LNG vessels that are docked around ports here in the country, which tells me that the short-term demand situation for LNG is also in stress. However, as economies slowly open up, we should see that coming back slowly but surely. On the longer term perspective, we all know that the new model of pricing LNG long-term contract is somehow indexed to prices of oil. So where oil prices land over a longer term period is key to the pricing of LNG. That circles back into the Qatari. Obviously, hydrocarbon revenue is very important for the region and for Qatar. And based on the revenue, we as Sheikh Hamad already said, countries will try to balance their budgets, and we could see some expense cut. Qatar is lucky in the sense that if you look at the structure of its its expenditure, around 45% of that is capex. So Qatar has a lot of flexibility when it comes to trying to be either one, balancing the budget, and to Sheikh Hamad's point, try to be counter-cyclical and trying to make sure that there's enough spending to incentivize the private sector to keep operational. So I think there would be a negative impact on Qatar's hydrocarbon revenues, and we could see retrenchment in spending. However, it is key to balance, the exercise of trying to balance a budget and try to make sure that the economy doesn't contract too much and make sure that the private sector is able to operate.
Okay, Akbar, what do you think? So, I mean, a few more questions have come in just to this particular topic. I think it's the same discussion around LNG prices, impact on budget. We will generally this also, since Qatar economy is primarily based on hydrocarbon business, where do you see business in Qatar moving to amid COVID 2019? This question is actually from Houston, Texas. So somebody is awake or Sahul. All right, Akbar, please go ahead. You need to unmute yourself, Akbar.
A lot has already been said. I'm not sure what I can add to oil and gas. I mean, it's clear that that we are in oversupply. It's clear that as lockdowns globally, which are starting to happen this month and next month, lockdowns ease and activity starts resuming. You've already seen a very strong jump in demand from China, where the lockdown is largely gone. So as the global economy starts recovering over the course of the summer in terms of resumption of activity, I don't want to say normalization, I don't think it will be normal, but a resumption of activity, you will start to see obviously greater consumption and a drawdown in some of these very significant inventories. One thing though that has been happened very quickly is that the production from the shale, from where the question has come from in Texas, the production of shale oil in Texas and North Dakota has shrunk very quickly already. And one of the big reasons is that these are privately owned oil producers. They're not the government. They're not governments. They react far more quickly. It's their own profits on the line, or losses, as it were. So we've already had about 1.5 million barrels of oil cut in terms of production from what's happening in the US. Now they can cut it quickly and they can put it back in quickly. But so far it's been cut pretty quickly, and that's also what's helping on a daily basis. As Bassam was mentioning, LNG is connected to oil prices. And Qatar has been diverting cargoes from Asia to Europe. But perhaps as China starts coming back on stream, some of that demand will come back in China as well. But I think overall, we live in a country which earns its income from a commodity which is halved in price. There is no there's no silver lining to that. The question is, how do we cope with that situation, and what means do we have at our disposal to cope? And the uncertainty is, if oil is $30 now. There's obviously a question you asked earlier as to where that price is going to be in the next few weeks and months. The point is that none of us really know exactly how long the global economy will take to resume its activity. There's obviously endless discussion about V's and U's and W's and all sorts of other letters that the resumption of the global economy, the shape that it will take, or a Nike swoosh sign or whatever else. The bottom line is nobody really knows. People are taking their best guess, but I think what everybody knows for sure is that normal in 6 months or in 12 months is not going to be how it was 6 months ago. It'll take a long time till people start flying as much as they used to go on cruise ships, to do all the things that they used to do before, for there to be the consumption of oil and gas, whether that's for industrial use, for power generation, or for whatever else to be how it used to be. So in that context, oil will, there's certainly room for oil and gas prices to go up and down from here, and they are clearly very volatile. And Mohsen, you mentioned we've seen a historic volatility. And really, I just wanted to mention the reason why Brent can't go negative is because WTI has is a physical contract. Brent is a financial future. So nobody actually has to take delivery of Brent crude. So therefore, it can't actually go to a minus number. You're not a forced seller in the same way, which is, I guess, good news for all of us outside of the US. But so we will have a situation where the questions are going to be around in a relatively depressed oil and gas price environment. And from our perspective, we care much more about gas. But we do sell millions of barrels of condensates and oil every day. So it's not just gas that Qatar cares about. How do we cope with that? Do we go down the counter-cyclical approach, which Hamad is talking about? Do we just cut? How is that done? And I think the relative resilience that Qatar has is obvious. The balance sheet is far stronger compared to most other hydrocarbon exporters. Russia is obviously very, very strong, but regionally, we are among the stronger ones. And also, and I'll just touch on this very briefly because I've seen the number of questions, that balance sheet allows the currency to be supported as well. There's a number of questions about the currency peg, and I'll just very quickly say something which will hopefully address all of them, is that the currency pegs across the Gulf are political and economic in terms of their viability. Like the euro is in Europe, it's not just an economic question. So if sovereign balance sheets become depleted and there is pressure on offshore currency rate, does that mean, and in case of Oman, that pressure is, the offshore currency rates would imply a 5% devaluation. That's obviously very high, and that's the highest in the region. The point, though, is that unless there is political will to break the pegs, it's virtually impossible to happen. And so for that to happen, I think, or therefore on that basis, I don't see the pegs breaking anytime soon. There is probably an argument to devalue some of our currencies because Russia found that its ruble was devalued significantly after the 2014-15 crisis, and it came through that crisis far better than most people expected. So this is a political question rather than economic question. Like the euro is a political question. Should the eurozone exist? Should, all of those questions around its existential questions? I think the short answer is the pegs are here to stay. Let's talk about something else because, whatever the merits or demerits from an economic perspective, I think the political realities suggest that this is not going to go away. So
Okay.
I've talked about things more than just oil and gas.
I think
I'll try to address the questions as well.
that function, one of them was about the peg, one of them was about the economy. I'll just answer those very quickly and then we can move on to the stock specific question. So just to add and finish off to Akbar's point about the peg, someone was asking me about the exchange rates resumed and do we see two markets developing where currency weakness is pronounced, i.e. an onshore and offshore rate. So if you take the example of Egypt and Lebanon, when they faced their currency issues and they, were squeezed, particularly Egypt, when we saw a full cycle how it went, you look for two things. We don't let you transfer a significant amount of dollars out, even as like a regular investor. When it's a routine transfer, there's a queue for the central bank dollar rate. The other is you start seeing a growing gap between the real market and the black market, even used by the guys at exchange houses, where you'll find people trying to buy hard currency and they pay early warning signs. I think any of the GCC countries is looking to abandon the peg. The one example where it wasn't a pure dollar peg, which is Kuwait, where they have a basket of currencies with the dollar being a heavy component. I think that in future, if the dollar moves harshly in one direction away from the euro, the pound, and a lot of other international currencies, they may consider it, but I don't think that there are any warning signs flashing about the currency at the moment. In terms of economic diversification, do you want to go downstream? This was in the chat slide. Do you want to go downstream or do you want to enter into other sectors? I think in terms of economic diversification, a lot of regional countries said they want to focus on finance, they want to focus on logistics, and they want to focus on tourism. Now, grabbing a piece of one of those pies, they're all very competitive. But the first area to focus on is what QP tried to do about a year ago, and inshallah it's a success for them, is the localization initiative, where they looked at 10% of their supply chain and said, can that be localized? Now, obviously, with an oil and gas company doing that, it's not diversification because it's still tied to the oil and gas economy. When you start looking at the broader economy and you start saying, what areas can I produce? What areas of production can I source locally? And that over time we can build competitively, and even being able to service yourself in these markets contributes significantly to your economic diversification. And then going forward, I'm sure we're going to find industries where we excel at, and we're able to find other export products that are not hydrocarbons. I believe that in the future, inshallah, we will do that. But step one isn't to pile hundreds of billions into the Chinese model, deciding that this widget is the best one to invest in and we should do that. I think it's more about just opening up the economy and encouraging organizations to start purchasing locally, to start giving off-take contracts to small local companies they believe can deliver, and really maintaining the growth of the white-collar employee. Another area that they could look at is what kinds of visa they issue. There are a lot of freelance businesses like personal trading, interior design, a lot of home products that foreigners produce don't have licenses for. There's small businesses that are potentially scalable to a reasonable degree. So perhaps this is another area where we can focus on saying that, could we license small businesses that are completely foreign owned, that are operated from the home, or freelance businesses, because every little incremental addition to the economy in terms of one extra consumer, one extra service being provided makes a difference. You're not talking about huge diversification that needs to happen overnight. It's small steps that will take time.
Well, I think, and also it's probably an opportunity for policymakers and for governments in the region and in Qatar to look at all these oil and gas pricing benchmarks and see if there is a different way to look at them and perhaps look at a gas benchmark, because most of Qatar's economy or revenue is based on LNG. Whether it makes sense, one of the actually comments from the attendees was to look potentially if there is a potential for Qatari government to look at a gas benchmark, given that Qatar is a largest producer of gas prices of gas around the world. But we won't address that for now. But I think there's merit for policymakers to look at that. Moving to the next part, which is around the outlook of. Sorry, Akbar, you want to say something?
I just wanted to maybe mention one point, which I'm looking at some of the questions, and also a point related to oil and gas. So obviously, we've been discussing about how there is a excess supply of oil, there's an excess supply of gas. We've seen Russia and Saudi act as, I would think, relatively rationally to try and effectively, rationally from the perspective of trying to kill the higher cost oil producers. Qatar, in effect, is playing the same game. We have the lowest cost of LNG production. We have stated plans to increase the output of LNG very significantly. This is a clear strategy to say, if you produce LNG and you don't like the prices, well, there's a lot more coming, so you should stop, because we aren't about to. We're the lowest cost producer. So there will be a period of pain. There is a period of pain, and it will last for a few years probably. But ultimately, the prize at the end of this is that the market share that Qatar will have at the end of LNG globally will be higher, as the higher cost producers eventually take the painful decisions to start switching off some of their production or canceling some of the new expansion that they were going to. Both of those things obviously benefit. So this is so Qatar is and has to take a longer term approach to being the giant and the lowest cost producer in the LNG market. Sorry, continue.
So moving to the next one, getting conscious of time now. We only have 20 minutes left for the webinar. There was a question on the Qatari stocks. I think Akbar will start with you while we have you, because the question came specifically for you about the QE index has dropped about 15% year to date. Do you think this is a good buying opportunity to enter the market now? I think you've been put right on the spot. So please, I would want you to speak up a little louder, because there's some issue with your sound. So
is this better?
No, just speak louder, I think. Anyway, go ahead.
So good. It's a very good question. Unfortunately, I'm not going to answer it in the way that the person wants it answered. We don't buy the index. We don't sell the index. That's what the ETF does. And if you want to buy or sell the index, that's what you should do. If that's all we did, we wouldn't have jobs to do. We're paid to choose stocks. And at present, there are stocks that we think are cheap. And at present, there are stocks that we think are expensive. So that's generally always the case. So our job is, and I say our, speaking for the three of us on the panel, our job is to choose effectively stock selection. So whether the market falls 15% or 40% or 5%, it depends on the situation, the demand outlook, the competitive situation of a particular company, etc., etc. So which is the answer to that question. So I'm not going to give you a neat answer, because that's not what any of us do for a living, is buy and sell the index.
You could tell us what's your view on Qatari stocks. I mean, the slide that I've just put on the screen is WHO declared pandemic around mid of March, or on the 11th of March, and since different other QE Al Rayyan Islamic Index is up 4.85%. Is at since the WHO declared COVID-19 pandemic. So interesting piece of information there. I think I'll move to Bassam to give some.
But we at Aventicum also manage the other ETF, the QE ETF on the stock exchange, and you can express your views on the stock market through that or a Rayan, that the Sharia compliant Rayan ETF. In terms of the outlook for the local market, I think it's important to put things in context. So one, clearly markets are forward-looking, so they tend to look through periods of stress and try to price in that stress. However, I'd caution that till today, I don't think we know what the exact impact from the COVID-19 lockdown is going to cause for local corporates, and I think Q2 will start to see some of that come in. Because as you probably all know, Q1 only reflected the last 2 weeks of March. So I think a cautious approach to looking at Qatari stocks, and as Akbar mentioned, is that you need to look at each company and its own merits separately, because even you'd find two companies in the same sector behaving differently with the same exogenous factors that are currently affecting the outlook. So I would be cautious, but cautiously optimistic. I think that what we're seeing around the world, and it's an experiment, because now we're looking at, we've done the lockdowns, we've gotten numbers under control. Now we'll start looking to open up, try to get business to run, albeit at lower capacity, and see how that works, how that goes. If we see, we could see another lockdown, with the second wave being even more severe, and we could see another leg down. So it's really what I'm trying to say is that be cautious. The outlook isn't yet clear, and you need to be nimble and flexible to adjust their views according to the data that you receive.
Sheikh Hamad, how do you see the Qatari market?
Okay, I think you might have some disappointed viewers because they didn't get single stock selection from Akbar and Bassam. I can't give you single stock selections either, but I'll try to be a bit more specific if I can. I think that you have you have a lot of, like Bassam and Akbar said, you have uncertainty about where the market's going. You want to see the Q2 data just to understand the level of impact that some of the companies are facing. Now, I don't think that a lot of really any of the listed companies have survival issues like a lot of the international firms do, where they're on the verge of bankruptcy or something. I think most of them are pretty well capitalized. They have good business models. They've been tested over the past 5 years with lower revenues, lower government spending, and they've been very resilient. So I don't think that the long-term investor, so if you want to invest yourself, pick companies you understand, look at the factors that would influence the different sectors. If it's something that you really don't know how to value, go with an ETF. I'll try to go through a few of them very quickly. So let's say the banks, this year, they're rescheduling a lot of the existing debt growth. You need to have a view on, are they going to be able to write a lot of business? Is there going to be a lot of fee income? Is it going to be flat compared to the previous year, or is there going to be growth? The real estate sector is very tied to the banking sector because a lot of the banks have real estate exposure. So if you believe that the occupancy rates of residential, the glut in terms of retail and commercial space is going to subside and you're going to have an upside, then both of those are going to do well. If not, then maybe, yes, banks are okay. Real estate companies, they're very undervalued compared to book value. They're all trading at a discount. How long will that discount last is one question. If you look at the telecommunications sector, it's pretty stable. There are only 2 telecom companies. I don't to start telling you which one my favorite is, but I do have a favorite I think has potentially is a better value proposition. Do your homework. The industrials, I think, and the family-owned companies are the trickiest ones to look at. I'll avoid talking about the family-owned companies for now. If you just take a look at the industrials, and I'll include transportation when I mention industrials, you have some of those companies are export-oriented, and they're tied to global demand for steel, for oil, for various commodities. These are going to continue to be pressured based on the global demand. But at the same time, you need to look at...
There is sorry to, just want to take a question. There's a specific question for you.
Can I finish? Can I get the question after I finish?
Yeah,
I'm almost done.
Consumer stocks. I mean, they're asking about consumer goods.
I'll get to the consumer stocks in a second. So if we look at the industrials, look for companies that are well capitalized, that can maintain their dividend, that you think have kind of reached the bottom. It's very difficult to look at PE ratios at the moment because the P's are already quite high. They're already taking a beating. So you need to kind of look at historical trends and find where the value line is. Now, if you're a client of one of the asset managers, they might draw the line for you. QNB does a lot of research. So QNB FS clients get their trading schedule, have a call. The guys there are very friendly. They're willing to have a chat with you about where they think the valuation falls, and they're licensed to have that type of conversation. I'd get in trouble if I start talking in too much detail on a public forum. The transportation index, I actually think there's a lot of potential. There's an outlook on, if there's a gas expansion, who's going to be doing the shipping, who's going to be providing the services. There's co-ownership between some of these companies, and there are some market participants who feel there's a discount there. So do your homework as well. If you're a trader, I think day trader, you're going to find more volatility, and you better have some cash on hand. It's not going to be an easy ride. Long-term investors, I wouldn't worry. Just avoid companies you don't understand, you think are too complicated, and the dividends have already been under pressure previously. Last year we saw some dividend cuts. It's too early for us to say whether or not dividends are going to stabilize, rise, or fall this year, but that's another question that a lot of investors are asking, and look for Q2 and Q3 numbers to make those decisions. That's why having a bit of cash on the side and being able to position yourself in the companies that you think are going to be, if you're a dividend investor, are going to be hold next year and the year after. So it's a very complicated market at the moment, but I hope I answered a few of your questions, or at least gave you a thought process to go through and analyze it. The consumer sector, honestly, I don't feel that we have a real consumer sector. We have companies like, for example, Salam, that does retail. It's probably one of the few examples of how the retail industry has been affected, because they have the real estate and they have the retail. You have companies like Almira, like Zad, like Widam, where I really don't see people eating less bread, less pizza, shopping at the supermarket less. So these are stable businesses. I think they'll remain to be stable. What level of growth they'll have, what other factors might influence them, I think those are questions that you might have to think about. Like, look at the dividend again, look at historic growth rates. But I really don't see us having a large consumer and a large service sector. I mean, that's a good thing and a bad thing. On the long run, you want more market depth. As an investor, I want to be able to invest in every single sector. I want to be able to go outside and say, hey, there's a boom in F&B in Qatar. Can I get in on that F&B market? Yes, there's a restaurant business that I like, that's diversified, that I'd like to trade. If retail is big, or online or digital is big, what companies other than Manna'i have a big IT exposure? You have Manna'i and you have the telecoms. So I think we want more diversity, but I don't feel that we have a huge consumer-driven sector. We have a few companies that provide consumer goods that if you look at the food-based ones and the groceries, I really don't think that there's a big impact of COVID on food supply.
I mean, there was an interesting
that was written there about I think they were talking about the 10 billion of market support, and someone was implying that it enriches the wealthy and it doesn't support the market. Now, just to be clear, the US, the Fed, is buying ETFs, it's buying corporate debt, it's taking a lot of measures to ensure there's liquidity. One of the few places in the country, other than the banks, where liquidity might be drained because of the coronavirus would be the stock market. Now, the government's already a large investor in the stock market. The large investor disclosures are there. You see, they don't day trade, they don't push prices up or down. They're long-term investors. And they announced, as per my understanding, that additional 10 billion to be allocated to the local market at their convenience that they can buy. So the government's not going to buy just to take stocks off my hands. I think that they would buy companies that they think are undervalued, that they like. And I also think that if they see there's a liquidity shock, they would put a bit of capital in to ensure liquidity continues in the market. I don't think that it's part of the government's responsibility to prop up the market and help us reach certain benchmark targets. And that's not what I believe is going on here at all.
All right. So with that, I think we have Scientific Interactive, where we have responded to a number of questions from the attendees. A lot of the questions were similar, so I think we've generally covered most of the topics.
While people are answering, I just wanted to touch on an excellent point that Sheikh Hamad made in terms of he was referring to, I guess, portfolio construction without calling it that, and I think it's an excellent point.
I can't hear you, Akbar. I think if you could just raise your voice a bit.
Can you hear me now?
Yeah.
Okay. So I was just saying that I just wanted to follow up on what I think is an excellent point that Sheikh Hamad made effectively about portfolio construction, and this applies at an institutional and at an individual level. One of the things that we've been doing far more, actually, probably since the last oil crisis, is having a higher amount of cash in our portfolios at all times, and being very opportunistic and specific on which stocks we invest in. Where we see opportunities, we're aggressive. Where we don't see opportunities, we're happy to sit on a higher amount of cash. So if you have conviction, exercise it, but don't just have money for the sake of having money in the market. That's something that the reason is because, as you heard, Bassam said that there will be two companies in the same sector and you'll have very different outcomes. So there's no point just saying, let me just have banks, because you're not going to, you'll end up with very varied results. Or let me just have petrochemical stocks. So I think that is an important part. Keep the cash to take advantage of opportunities of sell-offs, but also keep cash because you're not going to have that much conviction in everything. And the second thing is average in. There are a number of questions about uncertainty. There's a number of questions about the markets and the real economy and the mismatch. If you think there is a mismatch, and we all do think there is a mismatch, then keep some cash, and if you're taking a longer term view, average in. If you like XYZ stock today, don't just put in, you were going to buy 100 Riyal of it, don't buy 100 Riyal of it tomorrow. Buy 20 and then buy 20 more and then buy 20 more over a period of time. So if the market sells off in the meantime, you'll get it cheaper. And I think, so we do this when we're buying, and we do this partly from a liquidity point of view, because if we want to buy if we want to buy a stock across multiple portfolios, we manage more than $1 billion. We can't just say, okay, we'll buy it tomorrow. We do it gradually because we're forced to deal with liquidity. We buy gradually, we sell gradually, but the results are the same. And I think that's something that investors should think about. But the last thing I just wanted to say is, don't forget, we have a World Cup coming in 2 years. Despite all the doom and gloom and everything else, there is a big party happening starting on the 21st of November, 2022, and it'll be here, assuming it doesn't get delayed. But that's going to have a big impact on the stock market and on companies that benefit from a surge in population. And I'm not talking about the surge in population for 30 days during the World Cup. I'm talking about the surge in population for 9 months prior to the World Cup, for all of the people that are going to be coming in to make the World Cup possible. And then we have the LNG expansion towards the end of the decade. So if you take a long-term view, if you have a 10-year investment horizon, there are a number of triggers that are coming in Qatar. If you have a 2 or 3 month horizon, as Bassam said, Q2 results will be shocking.
So clearly, you guys have done a great job as panelists to sway the people away from gold, and they are more looking into equities now, equally to Qatari and global equities. So well done. Some people change their mind. Maybe they have traded in the market in the past. So and I think there will be more people who will be trading in the coming week and month. But I think it's still a lot more people are saying that they will be trading in more than a month's time. Actually, not that much. It's only 29% people who will trade after a month, but most people will be trading within a month. No plans of investing in real estate at this stage. No mortgage loans, so banks will see how they grow their credits. Travel restrictions. Yes, people want to travel, so that's a good sign. Some people, there are a few more people who want to have a staycation. So good news for domestic hotels. People still, no, it's okay. I think it's a past question, so we were not going to change the for this. So forward-looking questions. Yeah, we have been able to impact slightly more. People are bullish on longer-term view, or sorry, end of year. So there are about 70% people who think it will be in the -5 to 15% range, higher. Interesting. And on Brent crude, yeah, we can see that about 51% think it will be in the minus to positive 10% range. So, well done, everyone. I want to thank all the attendees who have stayed on and see. I think we will have similar sessions, more sessions after Eid. If you have any topics that you would want to be discussed by the Qatar Stock Exchange and other panelists, please do send them to us so we can take them into consideration and shape our future panel discussions accordingly. And we'll see you after Eid. Thank you.